In the market, there are two structures, a retailer's market structure and an advanced market structure. The retailer's market structure teaches you from the beginning that the market creates higher highs and higher lows, indicating an upward trend. If there is a break, the trend shifts. However, this is not always the case. You cannot consistently profit in the long run by following this structure. Why? Because the market does not operate in such a straightforward manner. The market may create a high, then a low, and then continue in a way that breaks the previous high, leading to a downward trend. According to your understanding, there should have been a break here, and the market should have shifted to an uptrend. But what happened? After breaking the high, the market moved into a downtrend. This is the advanced market. The top tier SMC represents Elliott's market structure, so let's begin the video on advanced market structure. Advanced market structure consists of three components. First, long-term highs and long-term lows, which we refer to as long-term swings. Second, intermediate-term highs and intermediate-term lows, known as intermediate-term swings. And third, short-term highs and short-term lows, which we call short-term swings. Among these, the most crucial is the intermediate-term swing. First, let's examine the long-term swings. These long-term swings represent the market's behavior, where we identify a high time frame point of control, PDR, an order block, a breaker block, a mitigation block, or a rejection block. From this PDR area, the market captured sellers and shifted its real market structure, indicating a significant change. This shift led to a downtrend, reacting from the high time frame PDR, which established a long-term high. If we reverse this entire scenario, we would arrive at a long-term low. I hope this explanation clarifies that a long-term high provides us with a narrative about the market's future direction, indicating what the market is signaling after reversing from a high time frame PDR. The market structure has shifted, indicating a transition from an uptrend to a downtrend. In simpler terms, smart money is reversing. Now, let's discuss intermediate-term swings, which are among the most significant swings in market structure. There are two types of these swings. The first type is classic intermediate-term swings, and the second type is rebalancing intermediate-term swings. Let's first take a look at the classic intermediate-term swings. In the market, we observed that it created a swing here, another swing there, and established a swing high at this point. Now, we have three swing highs. An intermediate-term high is defined as a swing high that has another swing high on both its left and right sides. This is what we will consider as our intermediate-term high. On the other hand, two smaller swing highs on either side are referred to as short-term swing highs. We will delve deeper into short-term swing highs later and understand their role in the market. This was our classic intermediate swing, which is not as significant. The more important type we have is the rebalanced intermediate swings, and we will explore what these entail. In our market, we had a fair value gap. I hope you are aware of what fair value gaps are. In this playlist, I will also create a video on the next fair value gap. If someone asks you what the most important aspects of the market are, what would you say? The market fundamentally revolves around two key elements, liquidity and fair value gaps. You may not grasp this right now, but in 1, 2, or even 5 years, it will become clear to you. Yes, the market operates primarily on these two factors. In terms of liquidity and balance, there was a fair value gap here. The market created a swing high, reversed, tapped into this fair value gap, and then continued with that swing high. The reaction from the market after tapping into the fair value gap gives us an intermediate-term high. Now, we have two types of intermediate-term highs, one classic with left and right swing highs, and the second high that taps into the fair value gap. Intermediate-term swings provide us with a framework for understanding market movements. This setup indicates what the market is doing, and it guides us on how to take entries. It gives us a complete framework, while short-term swings are also present in the market. Currently, liquidity is positioned at various levels in the market. There is liquidity above this high and below this low. The swing highs and swing lows, which have liquidity above and below them, are what we refer to as swing-term highs and swing-term lows. If you are unsure about where liquidity is located in relation to these highs and lows, it's important to understand what liquidity actually is, how liquidity functions, and how market liquidity operates, along with the processes of drawing liquidity and executing liquidity sweeps. I have created an advanced video covering all these aspects. The swings that occur in both intermediate swings to the right and left are also considered short-term swings. Long-term swings provide you with the narrative, while intermediate-term swings offer a framework, and short-term swings will give you entry. The market was on an uptrend, and we had a 4-hour break block that I marked. We will wait for the market to reach that point. You will notice that our breaker block is above, and the market has already started to decline. The market is creating an inducement here, as this high has not been breached. Additionally, observe that no highs are violating each other, indicating that liquidation is occurring and sellers are being informed. We are going to have a sale, so please hurry up and introduce all the sellers here. This will help boost the market and stop the losses. Look at what happened here. The market experienced a decline due to market displacement, followed by a rapid drop. This law was broken repeatedly, leading all retailers to believe that the market structure had shifted. There was a shock in the market, and now it seems that a downtrend is not about to begin. This loan has added further confirmation, and now all sellers are sitting on their positions, waiting for the market to act. The market will trigger their stop losses and hit our PD risk. The market has hit all the stop loss sellers in our PD array, and now we are waiting for the market to break this. Our real concern is about that. After the liquidity of the inducement is consumed, breaking the intermediate level becomes crucial. You will notice the swings. This is the intermediate swing. Once it breaks, we will wait for the market to establish another intermediate term high. When will this high be formed? It will occur when the market returns to the value gap. We had a fair value gap, as you can see. The market has now reached this intermediate term high. We will not take a direct entry here. Instead, we will wait for a short-term high to form and for the liquidity to sweep before making our entry. This has become our short-term high, and what we had was the intermediate term high. I will also note that this was our long-term high because it hit the high in the PD range, shifting the market structure in the higher time frame and providing a narrative that the market would sell off. Following that, we had our intermediate term high, which was established as it hit the gap again, leading to the formation of our short-term high. After the intermediate term high, we now have the short-term high. What do we do with the short-term high? It serves as our liquidity point, with liquidity resting above it, and I will also note this here. We have liquidity available, and the market will come here to sweep it. It won't break the intermediate term high, and from this point, we will establish selling positions. We will set our stop loss above the intermediate high and monitor what our target is. There are several targets forming below, and we will aim for the lower one. If this high breaks, it indicates our idea was incorrect. This way, our stop loss remains small, and we will place our stop loss above it. If the intermediate term high is breached, it means our market idea was wrong, and we will take our stop loss there. This approach keeps our stop loss tight within the market structure, and we will wait for the market to tap into our entry. Our entry has been tapped at boom. The show time has reached an intermediate high, while the violet has not changed. The long-term high remains the same. Here, we made our entry, and smart money from banks also entered, and they all went short.
Well, EP.
Here we have our TP, that is, the lower high and lower low. Keep searching for the entry. The market structure should ideally provide you with an entry point. This is the real market structure. Now, think like a retailer. We have a lower low and a lower high that has broken the structure. This break in structure has occurred, and the market has reacted here. Now, we will buy, as a retailer might think. However, the real market structure waited for this high to break. Once that high was broken, the banks entered, and the market fell. If you enjoyed the video, please subscribe to my channel and share it with your friends. Keep supporting. Goodbye.